Ever wonder who's really steering the ship when it comes to the U.S. economy?
Mhm.
We hear a lot about what comes out of Washington, but there is this other powerful force operating often kind of out of the spotlight, the Federal Reserve.
That's it, exactly.
Right.
While political decisions grab headlines, the Federal Reserve, quietly shapes our financial landscape in some really profound ways.
And that's precisely what we're getting into today. We're taking a deep dive into the origins, the authority, and the real impact of this critical institution.
Mhm.
And we're basing this on the book, The Federal Reserve, The U.S.'s Invisible Hand for World Dominance by Joseph Bonaparte.
Our goal for you today is, well, a clear and concise grasp of the Fed and its influence, not just here, but across the globe.
Right.
We want to unpack this idea of its invisible hand, understand its dominance, without getting too bogged down in, overly technical stuff.
We'll be drawing primarily from Professor Bonaparte's work. It gives us a great overview, the historical context, and a pretty strong analysis of the Fed's significant role.
It does.
Okay, so to get started, what is a central bank in the first place? And what exactly do we mean by monetary policy?
Okay, so according to the book, a central bank, like our Federal Reserve, is basically a public financial institution.
Okay.
Its main jobs: overseeing the nation's currency, setting and implementing monetary policy,
Mhm.
and supervising all the commercial banks.
So supervising the banks we use every day.
Exactly. Think of it less like just a referee, and maybe more like the rulemaker and enforcer for the banking system, making sure things run smoothly, preventing widespread problems, limiting risk, that sort of thing.
So it's the entity with the power to create the very foundation of our money system, the actual, like, base money.
Correct. The central bank has a monopoly on creating what's called the monetary base,
Yeah.
the fundamental building blocks of money in the economy.
Huh.
And a key principle here, at least in theory, is that it's designed to operate with a fair bit of independence from direct government control and, political pressures.
Okay, independence is important, which then leads us to monetary policy. What's the definition we find in the book?
Monetary policy, as the book explains it, refers to the actions the central bank takes to influence how much money is circulating and what interest rates are doing.
Right.
The Fed has several tools it can use, like changing the reserve requirements banks have to hold, buying or selling government bonds, which is a really big one.
That's open market operations, right?
Exactly.
Yeah.
And also adjusting the rates at which banks can lend and borrow from each other or directly from the Fed.
Right. So they have these levers they can pull. Can you give us a sense of how those levers work in, say, different economic situations?
Certainly. If the goal is to give the economy a boost, what we call expansionary monetary policy,
Hmm.
the Fed would typically try to increase the money supply and lower interest rates.
Make money cheaper.
Yeah, you often hear it called making money cheaper to borrow. Now, on the other hand, if the economy seems to be growing too fast and inflation is becoming a concern,
They pull back.
they use contractionary monetary policy. That means decreasing the money supply or raising interest rates, or both, basically to cool things down.
So lower rates are meant to make borrowing more attractive, encourage spending and investment, and higher rates do the opposite, making it more expensive to borrow.
Precisely. And it's really crucial to differentiate this from fiscal policy. That's the government side of things.
Right. Taxes and spending.
Yeah, fiscal policy involves things like taxation, government spending levels, subsidies. The book makes an interesting point here, too.
Oh,
It suggests that while the Fed is primarily focused on keeping inflation low and unemployment down its mandate, the government's objectives can sometimes be influenced by, well, shorter-term political considerations, like, the desire to get reelected.
that's a really interesting contrast. Different goals, potentially. Now, let's step back in time a bit. Where did this whole idea of a central bank even originate?
Well, the book touches on the very long history of money.
Yeah.
It even mentions ancient Egyptians using something called shat, tied to gold.
Wow. Way back.
Yeah. But the direct ancestors of modern central banks, they emerged much later, alongside more sophisticated banking practices. And initially, these early banks operated largely without any real government oversight.
So it was a much more decentralized system. Maybe riskier?
You could definitely say that. The rise of central banks really gained momentum with fiat money, that's currency not directly tied to gold or silver, and the international gold standard in the 19th and early 20th centuries.
Okay.
As banking crossed borders more often, The need for some kind of central authority to maintain stability became, well, increasingly clear.
In the book highlights some key early examples of these central banks, right?
It does. The Amsterdam Whistle Bank,
Hmm?
founded way back in 1609,
1609.
yeah, it's considered a really important precursor and played a key role in international trade, bringing more stability to how money was exchanged.
Okay.
Then you have the Bank of England, established 1694, which became a major model for others that followed.
The Bank of England, I've heard of that one.
Right. Interestingly, it was initially set up to help fund England's war with France.
Ah, funding wars again.
Seems to be a theme, doesn't it? It did this by issuing notes against government bonds. And the book even mentions a big currency crisis they faced in 1797.
Hmm.
It just highlights how early central banks were often, tangled up with government financing needs.
And the Banque de France.
Another important one, founded by Napoleon in 1800, again, largely to finance his military campaigns.
Right.
What's also fascinating, the book notes that many of these early central banks were initially owned by very powerful private families. Names like Rothschild, Hoddinger, Oppenheim.
Private families. Wow.
Yeah. But over time, there was this gradual shift towards these institutions becoming more public, with a mandate focused on the stability of the whole financial system.
So a move from purely private control towards more public responsibility. That's a pretty significant evolution. What about the history here in the U.S. before the Fed? It wasn't smooth sailing, was it?
No, the U.S. had a somewhat bumpy road. Alexander Hamilton, he was a strong advocate, helped set up the first Bank of the United States in the 1790s.
Right. Hamilton.
But its charter wasn't renewed. Then came the second Bank of the United States in the early 19th century. It also faced political opposition and eventually closed.
So 2 attempts failed.
Pretty much.
Yeah.
The book points to the Panic of 1907 as a really pivotal moment.
The Panic of 1907, what happened?
Well, a sharp stock market decline triggered widespread fear. Lots of bank runs. People trying to get their money out all at once.
Chaos.
Yeah, financial chaos. This instability really underscored the urgent need for a more secure, more stable monetary and financial system. And it directly paved the way for the Federal Reserve Act.
Which was signed in 1913.
Exactly. President Woodrow Wilson signed it into law in 1913. So you see, a major crisis was really the catalyst for the Fed's creation.
Okay, the Panic of 1907, a crisis directly leading to the Fed. That's a key piece of the story. Now, the book lays out some key historical steps for the Fed. Let's walk through some of those. It starts way back with early U.S. currency.
Yes, back between 1775 and 1791, during the Revolutionary War, the Continental Congress issued the first fiat paper money here called Continentals.
Continentals.
Yeah. Unfortunately, they printed huge amounts to finance the war. And that led to runaway inflation, even hyperinflation.
Not good.
Not good at all. The saying, not worth a continental, actually came from this time. It shows a complete loss of public faith in the currency. A tough lesson learned early on about managing fiat money.
Definitely sounds like it. Okay, then we jump forward to 1913 and the establishment of the Fed itself. What were the key characteristics of that Federal Reserve Act?
Well, the act established a system of decentralized central banking. It set up 12 regional Federal Reserve banks,
Yeah.
all overseen by a central board of governors in Washington.
So not just one big bank in D.C.
Right. The idea was to strike a balance. They needed centralized monetary control, but they also wanted to avoid concentrating too much power in one place, or just in the hands of, say, Wall Street bankers. It also had to address concerns from more populist movements of the time.
Interesting balancing act. And it didn't take long for it to become operational, did it? Opened its doors in 1914, just as World War I was kicking off in Europe.
Exactly. Timing, right. During the war, the Fed played a crucial role. It issued emergency currency to make sure there was enough money around.
Liquidity.
Right, liquidity. And it discounted these things called bankers' acceptances, which basically helped keep trade flowing. The book notes the Fed indirectly supported the war financially until the U.S. officially entered in 1917.
Okay. Then we move into the 1920s, and the book talks about the beginning of open market operations. That sounds like a really important development in how the Fed actually does things.
Oh, it was a massive evolution. Benjamin Strong, he was the head of the New York Fed, then realized that the old way of managing credit, relying mostly on gold flows, wasn't cutting it anymore. So, in response to a recession in 1923, the Fed started using government securities, buying and selling them as a tool to influence the economy.
Ah, so buying bonds injects money, selling them pulls it out.
That's the core idea. This practice developed into what we now call open market operations. And, It's arguably the Fed's most powerful tool today for implementing monetary policy.
Makes sense.
During this time, the Fed also started building more formal relationships with other central banks, especially the Bank of England. They recognized the world's financial system was becoming more interconnected.
So they realized they could directly influence the flow of money. But then, of course, the Roaring Twenties came to a screeching halt. Stock market crash, Great Depression. What role did the Fed play then, according to the book?
Well, the book points out that Congressman Carter Glass actually warned about dangers in the booming stock market before the crash.
He saw it coming.
He had concerns, yeah. But the Great Depression starting in '29 was just devastating. The worst economic downturn in U.S. history. Between 1930 and 1933, nearly 10,000 banks failed.
10,000. Unbelievable.
It led to a nationwide banking crisis. President Roosevelt declared a bank holiday, basically shutting them all down temporarily. The book suggests that the understanding of monetary economics back then was just inadequate,
They didn't know what to do.
or their actions weren't sufficient, maybe. The Fed's response wasn't enough to prevent or really lessen the severity of the crisis.
A stark reminder that even having a central bank doesn't make you immune to disaster. What were some of the key changes that came out of that terrible experience? The aftermath.
Well, a huge one was the Banking Act of 1933, famously known as the Glass-Steagall Act.
Glass-Steagall. Heard of that.
Right. It forced the separation between commercial banks, the ones that take deposits and make loans, and investment banks, which deal with securities.
Keeps them separate.
That was the idea. It also said government securities had to back Federal Reserve notes. And crucially, it established the FDIC, the Federal Deposit Insurance Corporation.
FDIC insurance, still have that today.
Exactly. It was set up to insure bank deposits, aiming to restore public confidence after all those failures. The book also mentions the growth of bank holding companies around then and Roosevelt's order forcing people to turn in their gold.
They took the gold.
Yeah, effectively ending the domestic gold standard. These changes fundamentally reshaped the whole financial landscape. That FDIC creation was huge for stability.
A real overhaul of the financial rulebook then. And the changes didn't stop there, did they? The book mentions more significant changes in 1935.
Yes, the Banking Act of 1935 brought more important tweaks. It formally established the FOMC, the Federal Open Market Committee.
FOMC. That's the one that sets interest rates now.
That's the primary body, yes, responsible for setting monetary policy. The act also removed the Treasury Secretary and the Controller of the Currency from the Fed's Board of Governors.
More independence.
Exactly, enhancing its independence. And it set the term length for board members at 14 years, trying to insulate them more from short-term political cycles.
14 years is a long time.
It is. And later on, other laws like the Employment Act of 1946 and the Humphrey-Hawkins Act in '78 formally gave the Fed goals like, maximizing employment and keeping inflation in check. And they also required the Fed chair to report regularly to Congress.
So the FOMC became central, and the Fed got more independence and clearer goals. Then the book discusses something called the Treasury Accord of 1951. What was the significance of that?
The Treasury Accord was really pivotal for the Fed's independence in practice. During World War II, the Fed had basically agreed to keep interest rates artificially low.
To help pay for the war cheaply.
Right, help the government finance the war effort cheaply. But the downside was the Fed had little control over inflation. After the Korean War started, this became a growing worry inside the Fed.
Okay.
But the Treasury Department, under President Truman, really wanted to keep those low rates to minimize borrowing costs. There was a conflict.
So Treasury wanted low rates, Fed worried about inflation.
Exactly. Fed folks like Chairman Mariner Eccles argued they needed to raise rates to fight rising inflation. The Treasury-Fed Accord resolved this conflict. It basically released the Fed from its obligation to automatically prop up government bond prices at a fixed low rate.
Ah, so they could finally set rates based on the economy, not just the Treasury's needs.
That's the essence of it, a crucial step allowing the Fed to pursue its own monetary policy goals, independent of the Treasury's immediate financing demands.
Okay, that makes sense. More autonomy. Then the 70s and 80s brought a whole different challenge. Really high inflation.
Oh yeah, the 1970s were marked by serious inflation. Factors like the oil price shocks in '73 and '79 played a big role, plus maybe some expansionary policies. By the late '70s, inflation was alarmingly high.
Double digits, right.
Yeah, got pretty bad. Then Paul Volcker became Fed chair in 1979. He took very aggressive action to break that inflationary spiral.
What did he do?
He sharply increased interest rates, really jacked them up. It caused a significant economic slowdown, even a recession.
Painful.
Very painful for many. Businesses struggled, people lost jobs, but ultimately, his policies are credited with bringing inflation back under control in the 1980s.
Yeah.
It really highlights the tough trade-offs the Fed often faces.
Absolutely. Taming inflation versus jobs and growth. Volcker's high rates were tough medicine. And the 80s also set the stage for a lot of financial modernization.
Yeah, the Monetary Control Act of 1980 kicked off a wave of big banking reforms. It made the Fed charge for its services, extended reserve requirements to more institutions, not just member banks.
Leveling the playing field a bit.
Kind of. This period also saw the start of interstate banks operating across state lines more easily, and things like interest-bearing checking accounts made the system more competitive.
And eventually, didn't they undo parts of Glass-Steagall?
They did. The Gramm-Leach-Bliley Act in 1999 effectively repealed key parts of Glass-Steagall. That allowed for the creation of these huge financial conglomerates, offering everything commercial banking, investment banking, insurance, all under one roof.
So a significant loosening of regulations there. Okay, then the 90s were mostly a period of sustained economic growth, right? Though not without bumps.
That's right. The stock market crash of '87,
Yeah.
soon after Alan Greenspan became Fed chair, was a big jolt.
Black Monday.
Right. The Fed responded quickly, basically saying, we're ready to provide liquidity, calm the markets down. That response is generally credited with helping contain the damage.
Okay.
Then you had the long expansion of the 90s. It eventually ended in March 2001, followed by a fairly mild recession. The Fed was active with interest rate cuts during the dot-com bubble phase and also during an earlier credit crunch in the early 90s. And importantly, inflation stayed relatively low through most of that decade.
Greenspan's Fed seemed very focused on responding to market signals, maybe. Then came the horrific events of September 11th, 2001. What role did the Fed play immediately after the attacks?
The attacks caused massive disruptions to U.S. financial markets, shut them down. The Fed immediately issued a statement, much like in '87, saying it was committed to providing liquidity.
You're sure.
Exactly. They opened the discount window wide. That's where banks borrowed directly from the Fed, made it readily available. They lowered interest rates and ultimately loaned over $45 billion to institutions to keep the payment systems running smoothly.
$45 billion.
Yeah. That quick, decisive action is widely seen as crucial in preventing a major liquidity crisis, a complete seizing up of the financial system.
A critical role in maintaining stability during an unbelievable national crisis. Then the book mentions some changes to the discount window in 2003 and then moves on to the financial crisis brewing around 2006. Obviously, a huge and complex period.
Yeah, the roots of the 2008 crisis trace back to the early to mid-2000s. You had low mortgage rates, easier access to credit. Home ownership became more attainable for many.
The housing boom.
Right. This increased demand pushed housing prices up rapidly. It was further fueled by the growth of mortgage securitization, bundling mortgages and selling them as investments, and the expansion of riskier subprime mortgages to borrowers with weaker credit histories.
And that ultimately led to the housing bubble bursting and the global financial meltdown.
Wow. Okay, so we've covered a vast amount of history there. Let's pivot now and focus on the Fed's structure, its goals, and its key responsibilities today, according to the book.
Okay. The book outlines several core responsibilities. Top of the list, implementing monetary policy.
Right.
That involves setting the target for the federal funds rate, the rate banks lend reserves to each other overnight, and managing the overall money supply. The author uses that powerful analogy, calling it the oxygen and water for the economy.
Oxygen and water. I like that. What else?
Other key jobs include managing the nation's reserves foreign currency, gold overseeing the printing and issuance of Federal Reserve notes, or actual paper money,
Okay.
working to maintain the stability of the entire financial system, supervising and regulating banks and payment systems, doing a ton of economic research and data collection,
So they gather a lot of info.
vital statistics, yeah. And finally, providing economic advice to the federal government. So it's involved in a really wide range of activities that, well, underpin our entire financial system. And the book mentions a three-tiered structure to help visualize this.
Yes, there's a figure 1.4.1 in the book. It illustrates the structure, Board of Governors at the top, then the 12 regional Fed banks and the FOMC as key entities, and then it outlines the 5 main functions the Fed performs. It's a helpful way to see the different layers.
Got it. And what about the Fed's primary objectives, the goals laid out in the law?
According to the book, the Fed's main goals, often called its dual mandate, come from the Federal Reserve Act and later laws. They are maintain price stability,
Keep inflation low.
right, which usually translates to aiming for inflation around, say, 2% to 2.5%, And the other goal is to promote maximum sustainable employment.
So keep unemployment low.
Yeah, with a target unemployment rate maybe somewhere around 3.5% to 4.5%. These goals guide the Fed's big monetary policy decisions.
But isn't there sometimes a trade-off between low unemployment and low inflation? How do they balance that?
That's the constant challenge, isn't it? Generally, yes. Very low unemployment can sometimes lead to rising wages, which can push inflation higher. On the flip side, aggressively fighting inflation by raising interest rates can slow the economy and potentially increase unemployment.
Tricky balancing act.
Absolutely. The Fed has to constantly weigh these trade-offs based on the current economic data, forecasts, all of that.
Okay, so those are the domestic goals. But the title of the book includes U.S. Invisible Hand for World Dominance. Let's explore that international side. How does the Fed exert global influence, according to Professor Bonaparte?
Well, the book argues that the U.S. emerged from World War II as, well, a dominant global power, certainly in the Western Hemisphere.
Okay.
And during this period, the U.S. dollar really solidified its position as the world's primary reserve currency. It's the main currency used for international trade and finance.
The dollar is king, basically.
Pretty much. So because the Fed controls U.S. interest rates and the supply of U.S. dollars, its decisions have a huge impact on exchange rates, the dollar's value against other currencies, and the dollar's overall strength globally.
So decisions made here ripple outwards.
Definitely. Decisions made in Washington can affect borrowing costs, trade flows, economic activity in, well, many, many countries around the world.
That's immense power.
It is. However, the book also points out that this dominance isn't unchallenged. It mentions growing opposition, citing things like the war in Ukraine and the rise of the BRICS nations, Brazil, Russia, India, China, South Africa.
Right, other power centers emerging.
Yeah, and the author even floats a controversial idea,
Which is?
suggesting that the U.S. dollar's dominance is linked to the use of political sanctions and might, perhaps inadvertently, contribute to economic problems and poverty in some parts of the world.
Wow, that's a really significant claim. Highlights potential ethical dimensions, even if unintended. Now, the book also talks about Executive Order 1110. This is something you hear about often with conspiracy theories attached. What's the book's take on it?
Right. EOL 1110, issued by President Kennedy, JFK, back in June '63. According to the book, its main goal was to limit the Fed's power to essentially create money and lend it to the U.S. government at interest.
Limit the Fed's power over money creation for the government.
That seems to be the interpretation presented. The order allowed the Secretary of the Treasury to issue silver certificates against silver the Treasury held, and also to issue Federal Reserve notes.
Okay. There are certainly theories about why Kennedy did this. Does the book get into those?
It briefly mentions them. It notes Jim Marr's theory that Kennedy was trying to take power away from the Fed and give it back to the government.
Okay.
It also alludes to claims by Richard Belzer about powerful groups working against Kennedy. The book does note the facts. Silver certificate redemption was paused in '64, then stopped completely in '68. But the author's main point in bringing this up, he says, is to highlight what he sees as JFK recognizing the Fed's huge, maybe inflatable role in the money system. He explicitly says he's not trying to dive into assassination conspiracies.
So the book uses it more as an example of a historical moment showing tension between the president and the Fed over monetary power.
Yeah, that seems to be the focus, yeah. It also mentions an amendment to an older executive order, 10289. What's the relevance of that detail?
Oh, right, that amendment, specifically adding paragraph J to section 1A of EO 10289. It initially gave the Treasury Secretary the power to issue those silver certificates and coin silver dollars for redeeming them. That power used to belong to the president directly.
Okay.
Then EO 10110 amended that again, explicitly giving that specific authority over silver certificates directly to the Treasury Secretary. The book uses this detail, I think, just to show the historical back and forth about who controlled different aspects of currency issuance, sometimes separate from the Fed's broader role.
Interesting, that historical context of shifting authority. Okay, finally, let's touch on the author's motivation for writing the book and any reform ideas he puts forward.
Right. The author explains his motivation came partly from seeing his students focus so much on elections.
Politics.
Yeah, electoral politics, while maybe overlooking the huge, less visible influence the Fed has on the economy. He uses that oxygen and water analogy again to stress how fundamental the Fed's role is.
Makes sense.
He also points out how hard it is to really control a Fed chair once they're appointed,
Yeah.
even if they had bipartisan support initially, like Jerome Powell, compares it unfavorably to raising children, actually.
Interesting comparison.
So his core aim seems to be educating a wider audience about the Fed's large and decisive role in shaping our economic lives.
So he sees a disconnect. Public focuses on elections, but this unelected body, the Fed, wields enormous economic power.
Exactly. The book suggests that, in many ways, elected governments actually have less direct power to shape the global economy than the Fed does through its monetary policy levers.
That's a strong statement.
Mhm.
What about reforms? Does he suggest changes?
He does propose an idea. He suggests the Fed should perhaps take on additional responsibilities, specifically the goal of actively working to lower uncertainty in financial markets.
Lower uncertainty. How?
Well, he observes that during volatile periods, like during some of Fed Chair Powell's press conferences in 2022, 2023, those events sometimes seem to increase market uncertainty rather than calm things down.
So be more mindful of how communications and actions impact market stability and predictability.
That seems to be the main thrust of the reform idea presented in the book. Not just focus on inflation and jobs, but also actively manage market uncertainty.
Interesting thought.
Well, this has been a really fascinating deep dive into the Federal Reserve, all based on Professor Bonaparte's insightful book. It's clear this is an incredibly powerful institution with, wow, a long and complex history.
Indeed. The Fed plays such a pivotal role, shaping not just the U.S. economy, but the whole global financial landscape. Through its monetary policy, its influence touches everything, really prices, jobs, international finance. It's huge.
So, as we wrap up, here's maybe a provocative thought for you, the listener, to consider. Given the Federal Reserve's vast influence, much of it operating away from the daily headlines, what does genuine accountability and effective oversight, such a powerful independent body, actually look like in a democracy?
Yeah, that's a big question.
And how should we as individuals, as citizens, maybe better engage with understanding and potentially influencing this invisible hand?
Crucial questions for all of us, really. In this deep dive, it's really just scratched the surface. There's so many more layers to explore about the Fed's impact.
Absolutely. The Federal Reserve is constantly evolving, and getting a solid understanding of its role is just essential, isn't it? Essential for navigating the complexities of our modern economy.